Welcome everyone to the Regiment and Rocket Dollar fireside chat. We've been doing a lot of these educational webinars, and the initial impetus for this is really starting is a lot of our customers have asset ideas, have investments that they want to look at, but they're not sure what type of investments they should be really targeting. Are they looking for real estate investments? Are they looking for certain types of investments? So we said, let's go through each asset class. Let's educate people on how you can get into those investments. We got through most of the most popular investments at Rocket Dollar. Now what we really want to do is kind of enhance the conversation, bring it to the next level, make this interactive. If you have questions for Eric, Mike, or I today, be sure to throw them in. I'm going to be watching the chat for Mike and Eric, and also throw in perspective that we can add here. So we got Eric. Why don't you introduce yourself, just in the real estate and notes world, the debt world, give yourself an intro, and then Mike, we can intro Regiment right after that. We can jump things off.
Great, thank you. My name is Eric Scharaga. I'm a full-time real estate note investor. For 13 years, I was a landlord and segued into mortgage notes, which I believe is just a really great investment. And I recently wrote a book about it entitled Lienlord. It was my COVID project. It took me about 6 months of intensive work. So I'm very proud of that. And I purchased both performing and non-performing mortgage loans.
Great. And Mike, let us know a bit about Regiment. We've done plenty of webinars here, but just for everyone in the room.
Yeah, no, thanks, Brendan, and thanks for being on, Eric, and we'll jump into the conversation here in a bit. Not to be a commercial, but Regiment is a digital investment bank. Ends up being our COVID project. We launched in March and have been heads down just building out our ecosystem to connect accredited investors to private market deals, to educate people through great partnerships like we have here with Rocket Dollar on what goes into a private market deal before an investor writes a check, the level of due diligence, the relationship that Regiment has had with Eric for the past few years. We'd like to really dive into that. And if anybody on here today has interest, we've got evergreen webinars that we've recorded with Rocket Dollar on both our and Rocket Dollar's website that you can learn more about our due diligence process at Regiment. But yeah, thanks for the intro and the great partnership with Rocket Dollar. And Eric, I'm just going to jump into asking some questions. And I'm glad that you mentioned the Lienlord and that it was your COVID project and it took 6 months to write the book, but probably over 13 years, like you mentioned, to actually get the content to write that book. And of the managers that we come across in the private market space, you're one of our faves because of the work that you do. Maybe you could just give us a little, high level span of your career of how you became the Lienlord.
Yeah, sure. I'd be happy to. So I was a teacher, high school teacher for 23 years. I was a real estate investor for 13, doing fix and flips and landlording. And I originally got into real estate investment because I was looking for a passive, low risk, stable investment. And over the 13 years, honestly, I found out that real estate investment, in my experience, was certainly not passive. It was a very volatile investment. And I really was looking for something that was much more stable. And after 13 years, I was just really burned out on real estate investment. I came across notes, and just investing like a bank is such a powerful opportunity. And so it really became an obsession of mine. And I spent about a year and a half learning everything I could about it, purchasing loans with my own funds, learning the business, buying both non-performing and performing loans. And it really allowed me to become a full-time investor, which was my goal originally when I started getting involved in real estate investment.
Very cool. Yeah, and the ups and downs of private market investing, I'm sure you've got plenty of stories there. You used the term performing and non-performing, and that's kind of one of the excuse me, one of the standouts as far as Damon Capital, the management of your fund in the performing, non-performing space. I think it's helpful if you just touch on that a little bit, on what you mean when you say non-performing and performing.
Sure. Performing just means that the loan is current and in good status. And non-performing means that at some point along the way, the borrower stopped making payments. And banks are not set up to deal with delinquent loans. They're in the lending business, not the collection business. So it's actually easier for them a lot of the time to pool these loans and sell them on the secondary market as non-performing loans. I purchase those, and the way that we turn them into re-performing loans is through a legal process. But the legal process is designed to keep the borrower in their home. That is the ultimate goal, and I'm proud to say that I've never, in hundreds of deals, ever displaced the borrower. We really keep the borrower in mind first and foremost when we interact with them and when we craft an exit based on really what their desires are.
Yeah. No, I think that's really good to point out that in the 100+ deals that you've done, nobody's ever been displaced. And correct me anywhere I'm wrong, but it would seem that the goal of your fund is to get the non-performing loans performing again.
Correct.
And the best way to do that is when the person that can make it perform again is worked with to get the loan performing and not just evicted and then fire sold on the house. Is that pretty accurate, that you're part of your
Absolutely.
secret sauce is you guys roll up your sleeves and get your hands dirty and work with people on the legal service side?
Correct. So the reason that these loans go into a delinquency, and first I'd like to say that I purchase what are called junior liens in second position, and I purchase non-performing junior liens behind performing first liens. And I do that because it tells me that the borrower has both the desire and the financial capacity to stay in their homes. And what usually happens is that borrowers experience a short-term financial difficulty, but by the time, which is usually years down the road, that these loans are sold into the secondary market as non-performing loans, borrowers' situations have changed, they've improved, and it's much easier to craft some type of exit that is satisfactory to the borrower. According to my internal data, about 60% of the time that's a loan modification. About 30% of the time that's a short payoff. And so, really, and we're working with the borrower with the hopes of keeping them in their home, because our desire is to invest as a bank, not as an REO company, real estate owned.
Yep. No, makes sense.
Yeah, and Eric, just asking for, a lot of our customers look at, they're interested in buying a single family home through an IRA or a solo 401k. What are some of the great advantages that you see of going into this notes, going into this debt lending instead of a direct ownership of a home through an IRA?
So, in my opinion, and in my experience, the greatest benefit to notes is that you know exactly what you're getting. You're buying a payment stream with a set number of payments, with a set purchase price, and you know what the minimum payment each month is going to be. Mm-hmm. In my experience in real estate, you would experience huge swings, move-outs, you would have evictions. I found that I was not allowed to depreciate in an IRA. Also, the idea of non-recourse lending was an issue. And just for me, in my experience, notes are a much more scalable business than real estate, because you're really outsourcing the majority of the work to third parties, i.e. loan servicers, who are going to accept the payments, they're going to interact with the borrowers, they're going to handle all the tax documents. And really my responsibilities are limited to checking to make sure I'm receiving my direct deposits every month.
Yeah, and we have an audience that does single family homes at Rocket Dollar, and those people love that investment. But honestly, not all investors are similar. The less pull of a note of a multifamily property, something that you have less hands on, keeps your investment experience. You can focus on investing, so you're not going to be pulling your hair out, going to go try and manage. Or because in an IRA, you have to have a decent amount of distance from a single family home property as well. So some people that can kind of confidently manage a property to themselves, all of a sudden have to pull back. They can't do repairs. They can't, have family members. You have to be careful which family member works and stays in the property. So a note kind of keeps you farther away from your investment and just financially through the debt side.
Correct. I agree with that. And, again, when you purchase, you know exactly what you're going to be receiving in terms of your cash stream. And, the people I talk to when I really explain both options, I think the majority of the people really are looking for truly passive investments, investing more as a bank than a hands-on operator. Although I do acknowledge that, there are benefits to both.
A couple of questions, I'm sure people in the crowd have, but, we've been working with you and Damon Capital for a while now, Eric, and, we field questions from investors all the time. One of the more prominent questions we've been getting is kind of more centered around this COVID lockdown and people's ability to pay the second lien non-performing behind the first lien performing. Like, have you noticed any nuances that have been popping up due to this lockdown with people's ability or frequency in payments? Any trends that you see that you'd like to share?
So people ask me that quite a bit. They'd like to know how our portfolio is doing through COVID. And at the beginning, I was expecting a pretty large delinquency rate. And actually, right now I'm at 96% of my performing inventory is current. One thing that I think is very important to acknowledge is that for homeowners look at their home differently than a tenant. And therefore, homeowners not only have financial equity in their home, they also have emotional equity. And in my experience, homeowners will do just about anything to stay in their home because it's an emotional and financial asset to them. Whereas in my experience, tenants looked at the rental property more as a transaction. So I think that there is a really big difference there. But in my experience, the whole notion of emotional equity in this business is just huge. It's the biggest part. And that's that people don't want to lose their homes.
Yeah, that's interesting, but good to know that, you were, as a risk manager, prepared and expecting a dent, and the dent really didn't come.
And I was expecting it. Actually, I was expecting it to be much higher on second liens. Wouldn't you expect that second liens would default at a much higher rate? And that just hasn't happened. So, that's been really an interesting phenomenon in COVID.
Yeah, and Eric, we just had a question come in, and this is sometimes people, they're looking for notes, but they don't exactly know where to first get them. So you work with us a lot. You have some funds. Where do notes appear? Where do they appear in real estate investor networks? How do people access them? How do people talk and find the best deal in the note space?
So I cover that in the book. And unfortunately, that is one of the harder parts of the business is locating the loans. Because for some reason, it's not like real estate where there's a centralized marketplace where you can purchase them. So you have to do quite a bit of networking to learn who the sellers are. And I purchased the majority of my loans through hedge funds, other investors, and through high-level brokers who just have a lot of industry connections. And I tend to purchase pools of loans versus individual loans. But that is difficult. I will acknowledge that. It takes work at the beginning to try to figure out who the sellers are because they don't necessarily advertise. But there are a couple of online platforms that you can purchase loans from. But I would really encourage people to make sure you get a mentor, talk to an attorney, talk to a CPA, talk to your financial advisor before you do it, because there are a lot of ways that you can lose money if you don't understand the business.
Yeah.
We,
From an
we,
educational aspect, I'd just like to dovetail on Eric's answer. There's the ways Eric's mentioning and explained in the book, The Lienlord, which we'll announce at the end. You're able to give away copies, hard copies, to anybody that wants to, can type their email address, and we'll hit more on that. But that's a great educational source, and the spirit of these webinars we've been doing are educational. Another way to invest in the notes is through an experienced risk manager that knows how to invest in the notes through a fund. And I know you have a fund that takes investment. And I always like to explain to people that, a risk manager in the asset management space, whether it's notes, whether it's direct real estate, whether it's cryptocurrency, they're worth their weight in gold, because yes, I can get my free copy of Lienlord, figure out how to do this, right? Figure out how to get the notes the same way that you're doing it from the advice that I'm getting from the book. But then my trade-off is time. Like, it's going to take me a long time to do this full time. So what I like to point out, when you find somebody that specializes in this and they have a fund set up, that's your trade-off. You're going to pay a fee to participate in that fund, to pay that fund manager for their time. And really, they're not paying for your time now. They're paying for your 15 years of experience in doing this, and knowing that they've got a professional risk manager that's going to be handling it. So really appreciate you pointing out that you're open as a mentor and as an educator. But I wanted to point out that a risk manager of an asset, it's worth paying those fees so you don't have to do all the work and take the 10 plus years to become a subject matter expert like yourself. You can invest directly in funds that invest in notes as well. So just wanted to point that out.
Yeah, and from the Rocket Dollar Investor Network, in the alt space, looking for your own investments is tough. Looking for the best deal is hard. When you're working with someone like Eric, who's been doing this a long time, they can both negotiate. They can buy, Eric can buy pools of notes. If you're going out to an online broker, that's great if you can find one or two diamonds in the rough. But it is on an online broker. We've talked to partners that give really great offerings there, but it is also an online broker. Why is it there? Maybe a private seller hasn't snatched that one up yet. So when you look to a private seller that's networking with someone like Eric, networking in a tight network, sometimes someone like Eric is going to have first shot at a loan that you might not be able to get. And that's something you can access through something like the fund.
Sure. Actually, I'd like to say that one of the things that I'm the most proud of regarding the book is that I dedicated a section to how an investor should properly vet a mortgage loan fund before investing. What are the tough questions that you need to ask the sponsor, the manager, before getting involved? And I go through that pretty in depth, and I provide the actual questions that you should be asking in the book.
Yeah, and someone just asked a question: what's the typical fees for paying for something like a risk management firm or fund to go through?
Sure. And I actually address that in the book. And my advice is that I really believe that a fund should be set up with no management fees whatsoever, because if that is the case, you know that management must be very confident in their ability to set up a fund that's going to be profitable for the investor first and for them second, and they're not just going to be relying on management fees. So my answer to that is that ideally, there should be no management fees.
Okay. And one last question came in, and then we'll move on to the next one. What's the name of the funds, Eric, that you have?
I would rather not.
Okay.
I would rather not.
We'll move on to the next question then.
Yeah, I think for anybody that wants to talk more about the investment, they can either reach out to me, Brendan, or Eric directly, or if you type in your email in the chat, we'll follow up with you. There are accreditation rules that we have to do a little background before we can discuss performance fees and names of things. And I think Eric's not being shy or, distant, but the purpose here is education. We're happy to share that info once we can do the proper regulatory legwork so nobody gets in trouble. This isn't a solicitation. This is purely educational. Yeah. So
That's
appreciate
100% true.
Yeah. Appreciate the question. Keep the questions coming in. One other point, that we've enjoyed working with you on, Eric, and of the many points, but one thing that jumps out top of mind and is relevant to the fee side of the conversation and, the work that you're doing. One thing that always jumped out with me, one, the level of care, and you already mentioned never displacing a homeowner, but the amount of work you do to get that loan performing again, like the legal work and just outreach to that person. Like, maybe you could go a little bit more in depth to that. I'm sure there's people that are like, what, who are you? Why are you calling me? Like, the work that you have to do. Yeah.
So let me explain the process. We don't call anyone. It is all done by attorneys through a state level legal process. So we just turn the file over to an attorney. The attorney's going to file a foreclosure case, but the foreclosure is only filed to get the borrower's attention. We have no intention, again, of displacing any borrowers. And at some point in the foreclosure process, the borrower will reach out, or the borrower will hire an attorney, and that attorney will reach out, interested in some type of a workout.
Gotcha.
So we do not call people. We do not enlist people who call people because A, it doesn't work, and B, there's a lot of legalities with that. That it's a much safer route to enlist the appropriate individuals, which would be an attorney.
Gotcha. So, and that's not free, right? I mean, the attorneys have to get paid, and how does that work? Does that come out of the fund itself, or how does that get worked out?
Correct. That's an expense to the fund. And actually, I track all of my data on pretty much every deal I've ever done. And so I know all of these figures. I know the averages. What is the average expense for legal for each file? What's the average ROI? What's the average yield on the reperforming loans? What's the average servicing expense? So I track every single one on the loan level, and I constantly am tracking and expanding that data set.
Yeah.
But it is expensive. I would say it's about $3,000 to $3,500 per file just in legal fees.
Mm-hmm. And Eric, is this work, that a bank would sometimes do, or you're just doing more than a bank? Because it seems like a lot of these loans can perform. They might just need a little bit extra work from your team, getting in touch with the borrower, getting them back on track.
So with first liens, you will see banks keeping those in-house and filing the foreclosures themselves. Mm-hmm. But with seconds, in my experience, they just don't have the systems or the desire. Why would they foreclose on a property to take the deed subject to a first lien? Mm-hmm. It just doesn't make much sense to them. And therefore, it's much cheaper and smarter for them. The other thing is that they don't have the systems. They don't have the employees with the knowledge. It's cheaper and smarter for them to just pool the loans and sell them off.
Yeah.
And write them down, because once they sell them, they can put that capital back into more loans, more lending, recirculating fees, etc.
Yeah, and the reason that I just asked, because as you're talking about throughout the presentation, that seems like an area an investor with knowledge can hop in. When one company is kind of stepping back and stepping away from the situation, that's when an investor can pop in and look for value.
Yes. Yep.
We had another great question pop in the Q&A here from David. How do prepayments and refis figure into your model?
So it's an extremely important part of it, because all of these loans are purchased at a discount. So the discount for a non-performing loan might be 20 to 40% or 20 to 50%. The discount for a performing loan will be 50 to 90%. So when the borrower either refinances or sells the home, that difference that you paid in discount is really an extra ROI. And what I'm seeing right now is that a lot of people, especially with second liens, are refinancing. And if you're purchasing at discount, you're going to see a huge ROI boost when that happens, beyond what you expected for your initial yield calculation.
Got it. So it's better to get prepayments.
Oh, absolutely. I mean, the downside is that you're going to have to go back out to market and purchase more loans. But the great thing is that you're going to see a huge ROI boost because of the fact that you purchased the loan at discount, sometimes at an extreme discount.
Got it. No, that's helpful. That was a great question. And keep encouraging people to keep the questions rolling in. When you're buying these loans, maybe you could walk us through that process a little bit. I know you mentioned with you've got brokers, you're buying from the banks. Like, what's the value? Like, that's got to be, without giving away any secret sauce, or what's the value there? Like, the range of what you look to buy these loans for. I would imagine that's like a big part of the alignment of the fund and how it can return.
So it's different for performing and non-performing. Did you have an idea of which one you wanted me to talk about first?
You could maybe, talk about performing first, and then you can talk about non-performing second.
So performing, I simply purchase on yield. I'm going to do a yield calculation, and based on a bunch of factors involved, really the borrower, the state, the collateral property, a lot of different factors, the collateral documents, I'm going to put in a bid. But a lot of times it has to do with the motivation of the seller. If the seller's motivated and they have something on the horizon in terms of another deal, they might be much more motivated to take a bigger discount. So I'm doing the same due diligence on all of the loans when I purchase performing loans. I've got a yield in mind that I'm looking for, but there's going to be negotiation back and forth. A lot of times and I go over this in the book, I start out by asking the seller what their pricing expectations are.
Mm-hmm. And Eric, just a question, not in any minimum investment of a fund or anything like that, but when a note investor first starts looking at notes, obviously these values can vary. A lot of big question of the real estate investors is, okay, how much capital do I need before I can actually get into something like this? Typically, if it's a performing note or a non-performing note, where are certain dollar amounts people can buy like one note? How much capital does that take?
So I do not recommend that beginning investors purchase non-performing notes. There is a risk element there that I would say that it's much smarter and safer to start with performing loans. But I would say if you just wanted to start, and I go over this in the book, if you wanted to start with, let's say, just a $10,000 commitment, you could buy what's called a partial note, which means that you purchase a number of payments from an existing loan that another investor has through a partial note sale contract. The note is assigned over to you. You own it during your period of entitlement. You collect the payments, and then when you receive your entitlement, it will revert back to the investor for the tail end. And I go over that process in the book. So you could start with $10,000, $15,000 if you just wanted to test the model.
Yeah, and that's a question just from a lot of our customers. A lot of funds just have a $50,000 limit. That's just how life is. That's the face of things that a lot of fund managers have to deal with and investors have to deal with. So we have a lot of real estate investors that love real estate, but they bring us an IRA. They have below 100,000. Sometimes they have 25, sometimes just 10. So, these are things that you can work your way up. People always think, I need to own a single family home property in my IRA. Think about other real estate options that you maybe know, or you have some side knowledge that you could really get into quickly, learn that up quickly, and you can work your way up to different asset sizes.
And the great thing of partials is that the seller is going to walk you through all of the due diligence, and the seller really is going to backstop the loan and the payments, because remember that the seller retains the tail end of the loan. So the seller isn't going to do anything to allow, that loan to go awry, because the seller doesn't want to lose that tail end. So while the seller isn't guaranteeing anything, the seller's going to step in to backstop it, if anything, if it goes non-performing, to protect the seller's tail end interest.
Right.
So it's a way to learn the business without a huge capital commitment.
Yeah, we got another good question here. Kind of a compare and contrast question. How does note investing, like with what you're doing, and how you explain it in the book Lienlord, how does that compare to more traditional investments? Like just in general, like a market landscape of, and I'm assuming general, traditional investments means like bonds, corporates, municipals, treasuries, like the different types of traditional yield bearing investments. How does note investing compare?
So I actually go over that in the book. I'm really glad that you asked that question. I go over comparing mortgage loan investing to traditional investments like the stock market, bonds, annuities, real estate. And actually, I think that mortgage loans are very similar to bonds, with one key difference. I mean, I'm not really interested in a 2% yield. I want like a 9% yield. And so, in my experience, the yields for mortgage loans, either the whole loan or in a mortgage loan fund, are much higher than what's currently being offered in the bond market, unless you're buying high risk junk bonds. And even there, I would say, compared to what I've seen recently, I would say the yields for mortgage loans can still surpass that. So I would say the biggest difference is just the yield differential.
Yeah.
And the other thing that I explore is that, bonds are not completely risk free. And what I love about mortgage loans in a fund is that you're really spreading your risk across the country through hundreds of American homeowners, and you have to ask yourself, how many American homeowners are going to walk away from their homes and their equity or end up losing their homes? And it just doesn't happen. Even as a very last resort, Chapter 13 bankruptcy is designed to keep people in their homes who want to stay, who are going through financial difficulties. So there's plenty of options for homeowners who are even in, experiencing very difficult financial times. So I like personally investing in American homeowners. I think it's one of the safest investments.
Yeah. And so we at Rocket Dollar, we have, usually when people are coming to us, they're either looking for home runs or they're looking for yield. And this really lines up with our yield audience. Often people are not coming to us just to replace their stocks. They're coming to us to replace their bonds because they've been frustrated with those. So we had a few questions roll in. And how does maybe a basket of notes or notes individually, how does that compare to a mortgage REIT, David was asking? A real estate investment trust?
So I would say that, a private mortgage fund, the yield is still going to be higher. If you buy mortgage bonds, those barely exceed treasuries. In terms of a mortgage REIT, I'm not completely familiar with where all of their yields are. But I would say that you would want to see about a 9 to 10% yield, 8 to 10% yield in a mortgage fund. That's what I would recommend.
Yeah, and when people are looking, of course, the brokers and custodians of doing stocks and bonds, there's so many great funds out there. But when people look at real estate funds that are publicly traded, often people are pretty disappointed, with their options, what they're getting. These are things that, with Rocket Dollar, we're trying to say, hey, look, get some access to the private markets, because there is a lot more opportunities out there than people, the couple REIT traded funds that are out in the custodians. We had a question here. What's a typical yield of notes that, it's a very wide open question, but what's a typical yield of notes that you're targeting right now, Eric? Maybe in performing and non-performing.
So for performing, I personally, for my portfolio, like to be in the double digits. Mm-hmm. And there's a wide span there within the double digits. I've achieved yields in the 20s, but there's a myriad of factors there for how you get there. Non-performing, it's a much different investment. Right now, according to my data, my yield on reperforming loans is at 50% for the ones that I'm currently holding in the portfolio. But overall, I'm successful on 94% of the non-performing loans. But you are going to experience losses with non-performing loans. It's just the nature of the business. So as a blended yield, I'm at 50%. Okay. Now, I can't say that will continue, but historically, that's where I've been at.
Mm-hmm. And so we had another COVID question. I think we covered this a bit in the middle. Eric was saying, expecting a dent. You haven't really seen a dent, but this question was out the supply side. Do you expect the supply side to maybe increase or see something of notes through after the COVID reverberations throughout the winter here?
Yes, absolutely, especially in second liens.
Okay. As banks are just trying to offload some extra risk and things on their books.
I have a feeling, I am not an expert on this, but I have a feeling that what will happen is, it may be years from now, but there will be some borrowers who stop paying second liens, second mortgages, and never resume. And banks don't really have the setup they'll send some letters, they'll send some offers, they'll make a few phone calls, and then they'll just write those loans down. And at some point, they're going to look to sell those on the secondary market. I have a feeling in the coming years, we're going to see more and more of that inventory.
Interesting. Speaking of inventory, we got some good questions rolling in here. Lou asked again, a geographic focused question. Have you found some parts of the country better than others for your process for the note buying investments?
Yes, I definitely have favorite states. There are some states that are very difficult, some states that are not. I joke that an attorney is responsible for knowing the laws in one state, whereas I'm responsible for knowing the laws in all 50 states. And there definitely is a learning curve there. So,
do you delve into that at all in the book Lienlord?
No, I don't okay. Talk about the specific states. I just talk about how important it is and the benefit of being able to spread your risk. In real estate, all of my properties were located in one area, Chicagoland. And, what if there's a natural disaster or what if if you're in a small area, one major employer moves out? And in mortgage loan investing, I'm spread all over the country. And we know that in times of recession, not all areas of the country are affected in the same way. So that really provides an additional hedge against risk, that you really own loans everywhere in all the states. And it's a real benefit.
Yeah, to add that, we just had a webinar with our partner bank on Tuesday. So they're kind of on the other side of Eric. They're in the beginning of the lending process. They do every state except for New York and New Jersey. There's a lot of really pro-tenant rules in there that they talked about, which are great for the tenants. Sometimes it makes it a lot tougher for everyone down the line. to get their liens and get their payments, eviction, stuff like that.
So I will agree with that. That in my experience, especially New York but also New Jersey, are difficult.
Yeah, and that's been a consistent theme from a few. Just anyone on the debt side of real estate has mentioned that, or sometimes the more direct or multifamily investors. Tough states to perform in.
No, that's great. One question we get a lot just in the private market investing side of things are duration. If somebody invests in these notes, like I'm sure there's no one note that has a set duration, like it can vary and everything, but typically how long are you invested in one of these, performing or non-performing notes that you're purchasing? What's the holdup as far as how long it ties up capital?
Well, they say that the average American mortgage lasts for 10 years. I don't track the metrics on how my average holding time for a performing loan, although second liens are paid off much more frequently than first liens because they're refinanced into first lien, like they're refinanced into one loan. In terms of a non-performing loan, if you're asking how long it takes on average for the process to go from purchasing the loan to some type of workout, that is 11 months. So I would say that about a year is a safe expectation if you buy a non-performing loan before you're going to see some type of resolution.
Mm-hmm.
Got it. So just to set that level of expectation, as you're managing your own personal finances, that's a good lockup to tell yourself, if I'm going to start looking into this as an investment choice as part of my portfolio, I'm going to not have liquidity in that type of investment for 12 months.
Correct. And again, I'd really like to stress here that for a beginning investor, I do not recommend that you run out and purchase non-performing loans. There is an extremely high learning curve in that business. There are about 15 ways you can lose your money, and you just really need to know what you're doing before you get involved in that. It is much smarter, safer. There's still risk, but I would recommend that investors get started either by investing in a fund or investing in performing loans.
That's good. It's good to point that out. I really appreciate you saying that. I always tell people, investing in something new is like riding a bike. When we all learned how to ride a bike, you fall down, you skin your knee, you get back up, and maybe the second or third time you get it. Investing similar, except you're not skinning your knee, you're skinning your finances. You are going to lose money when you start something new. It's just the truth.
Yeah. So really what you need to do, if you do decide to get in the non-performing loan space, you must have a mentor, you must have an attorney. You can never be too careful. And again, that's even why I put the section in the book about how to vet a mortgage loan fund before you invest. Because just because somebody's a nice person doesn't necessarily mean that they're a good fund manager. Mm-hmm. And what I really encourage people to do is ask to see the fund financials. They should be able to tell you exactly where they're at in terms of investor income, assets under management versus what they're bringing in on a monthly basis, and fund UPB, unpaid principal balance, versus invested dollars. So there's a couple key data points that you definitely should be reviewing with the sponsor.
Mm-hmm. And yeah, so we're at 45 minutes here, Eric. I know if we have any other questions left, feel free to throw them in at the end here. But one question that's very beginnerish that I had to learn, and we have new debt investors all the time. Can you just get into what a first lien is and a second lien is, and how that tussle will actually happen if there's a struggle, maybe someone's not paying, a foreclosure? How does that legally play out, and how do all the interested players get paid?
Correct. Yeah, I should have covered that earlier. Thanks for asking that. So a first lien is recorded first in time, mm-hmm. and a second lien is recorded second in time. And what that means is that the first lien has first priority for payoff Second lien is second priority for payoff. And what people get concerned about is that in the event of a foreclosure action, the first lien is going to be paid off first, and the second lien is going to be paid off from any remaining funds. And if there are any remaining funds, that's why it's important to buy second liens with equity. But in my experience, the other issue that can happen is that a second lien can be wiped in foreclosure, which means that the lien will be released and no longer remain on the property. I have never had that happen before. In my experience, what happens more often if you purchase loans with equity, second liens with equity, is that a borrower will file bankruptcy before they'll just walk away. It's very rare. I've had very few files that I've ever done that the borrower has simply just walked away from the home.
Mm-hmm.
And I hope that answered your question. Was that a good answer?
And I haven't invested in much in debt myself. So, it's something that I know because I do this every day and I have a cursory, extremely surface level knowledge of this. I know that's something that investors first coming to this space, they're going to want to know what a first lien is, a second lien is. They're going to want to know who the bank is. Like if I have the second, who's the first lien? These kind of things really help people ease the investment if they would feel comfortable even having a second lien style of investment, what's right for them. So we're here at almost 15 minutes. Thank you everyone for coming in here. Mike, you got any other questions for Eric before we close up?
No, I just, again, super grateful, Eric, that you chose to spend some time with our audience today. Always happy to see you, Brendan, and the Rocket Dollar Nation. We're out of questions in the Q&A. Eric, is there anything you want to touch on or that we should mention? I did put the link to Lienlord in the chat. It's 99 cents to get the Kindle version, and you made the generous offer that you'll send a hard copy to anyone that sends their address. You'll send a copy of the Lienlord, the hard copy. So that info's in the public chat. Eric, is there anything that we didn't ask or that you want to touch on? We did get one last question from Micheal here. She's asking how competitive the market for buying these notes is.
For the non-performing loans, it is extremely competitive right now. For performing loans, it's less competitive, but you need to know where to purchase.
Got it.
In closing, I would just like to say thank you for having me. Thank you for allowing me to explain a business and an investment model that's been extremely powerful for me personally. And if anyone is interested in a paper copy of the book, feel free to email me. My email is Eric, ERIC, at Damen, DAMEN, capital.com, and I will ship you a paper copy of the book. Also, if you look on Amazon, I have some special reports on there as well on issues relating to ideas that I explore in the book.
Great. Cool. We'll try to throw that out when we have the recording out here.
And maybe, Eric, for the recording's sake, maybe you can type your email in the chat so everybody has a chance, and then the people that watch the recording will have the email as well in the chat.
Okay, yeah. Did that come through?
Yep, I got it. I'm going to also put it in the public chat, and you put it in the Q&A, which is great. I'm going to put it in the public chat as well.
Okay. Yeah, and just some housekeeping for Rocket Dollar. We have a $50 off coupon code for Rangers. If you put in Rangers or Regiment, put in the word Regiment, you can get $50 off your Rocket Dollar account. We have a lot of real estate investors looking at solo 401ks right now. Those are due December 20th for us. If you to get open by December 31st. So a lot of small business owners, real estate investors are trying to get that going. So if you have any retirement questions, feel free to email me at info@rocketdollar or call our sales line, schedule a call. We're happy to talk about it. There's plenty of opportunities and stuff that you can check out through the Regiment website, and also check out Eric's book and his literature as well. Thank you everyone for coming.
Yep. And one last thing, we've got a great partnership with Rocket Dollar. So when you open the account with them and you save the money, Eric's deal, I think we had to retool one of the the parts of the deal. I don't know if it's listed right now, but when it's back up listed on our platform at regimentib.com, you can go directly to the website, go through the proper regulatory channels on our website, and when you're ready to invest, our software is integrated with Rocket Dollar, so you can just fund the deal once you go through the other regulatory aspects of the deal. You can fund directly with your Rocket Dollar account. So
Yeah,
not to get too salesy, but we try to make everything easy.
We got an awesome API, and we're going to be upgrading that real soon. So it's really exciting stuff. So thank you, Eric. Thank you, Mike. We're going to stop everything, kick everyone out today. Thank you for everyone asking for questions.
Thank you, guys.
Thank you, Eric. Thanks, Brennan. Thanks, everybody.
Thank you.
Have a great day. Yep. Bye-bye.